Those expressions are often trite and not backed up with data. I understand why people say it because most of the time you shouldn't fight the Fed. Although we do know that in 2001 and 2007, both times the market went down 50%, the Fed was cutting rates the whole way down. So I don't think this is a financial crisis. I don't think this is a dot-com bubble. When people compare this market to 99, I think it's irresponsible. It looks nothing like that except for a few stocks, but we're getting much more broad participation now than we did in the late 90s. So look, the Fed's going to cut again. I would say this, I'll be an outlier as usual and say the economy is going to reaccelerate right now. As we're speaking, I think the jobs market's going to firm up, and I think GDP is going to surprise to the upside for Q3 as well as Q4. Longer term, I thought inflation began to die in early 2023. I think the Fed is fighting the wrong battle. I think people are focused on the wrong thing. I thought the second half of this year, inflation would be warmer, but not hot, and not go back to 4 or 5 and higher. I think that notion is absurd. We could print a few months of inflation, in the upper 2s to even low 3s, but the longer term trend is lower. We have disinflation. I think inflation is stable. Look, in the 90s, and the historical average for inflation is 3%. And markets have done absolutely fine over time. But people are, we're always fighting that last battle. And that's not the battle we should fight going forward. So here's the challenge. The Fed's always behind the curve. I don't know why the smartest people on earth do this from Greenspan all the way through to Jay Powell. They're behind the curve. I pounded the table. They should have cut rates in March. They should have skipped in May and cut rates in June. They're going to cut another quarter point because that's where the 2-year note is. The 2-year note wants another rate cut or two. But here's what happens with the markets and the Fed. This recency bias, taking the most recent data and extrapolating it out, is what ends up happening. If we get some warmer inflation, but not hot inflation, and if we get GDP growth that has a possible 3 handle in front of it, the market will adjust, and we may get one more rate cut. Maybe we'll get 2, and I think they're going to stop. This is not the beginning of a grand rate cutting cycle. I know there's an outlier, a new person on the Fed who's an outlier. I get it. I firmly disagree. It looks to me like job growth is going to start to reaccelerate. GDP has already reaccelerated. And we have all this deregulation from the tax and spend bill passed in July that is just starting to get in the economy. And people shouldn't underestimate how important or how big a role deregulation can play. It did happen in 2017, and I don't have to remind everybody how good the economy and markets were in 2017. So in 2022, I was on, not this show, but another show. Our model in 2022 said before the bull market ends, the Dow will hit at least 50,000. And at that time, everybody laughed and thought I was out of my mind. And now here we are. I think the market's going to 50, Dow's going to 50,000, S&P 7,000 by Q1 of 2026, because that's what the math says. With earnings reaccelerating, with the economy reaccelerating, that's where the market's going. You remember 3 weeks ago, everyone was worried about the Ides of September. It's the most bearish month of the year. And look, it's really, I get why they say that, but next week is historically the weakest week of the year. And that's what September boils down to. I think so many people panic sold that first week of April. I would estimate, in my view, hundreds of billions of dollars of big money panic sold. They hated and disavowed the rally in May and the rest of April. And that's why the pullbacks have been so minor. You've the great performance chase, so many managers on so much cash who are now see the end of the year coming. They're like, holy geez, we are so trailing our benchmark. We're sitting on cash. The market's melting higher. Any 1 to 2, 3 day pullback, you're seeing fresh money come in, even though I get it. Valuations are high and they're stretched, but valuation is the worst timing tool in investing. So I think on balance, you're going to get a stronger move into 2026. It's hard to get a major decline in Q4, except for 2007 and 2018. And isn't it fascinating? Now we've got the Fed cutting rates. Look, the 10-year went down before the Fed started cutting rates. So I'm not surprised it's backing up a little bit. But think of how great it is for the banks. The Fed's going to cut the short-term Fed funds rate, and maybe the 10-year stays stable or yields go up a little bit. That spread is a steepening yield curve, to get wonky for viewers. That's really good for future economic activity. And the banks become, poor pun, but the banks become an ATM machine. That's when they make their most money. So people need to be careful with these all or none things. Well, if the 10-year goes up a little bit, what does that say? It's okay, because the 10-year is looking out at the next 6 to 9 months of economic activity. I think it'd be great if a 10-year stayed stable in the low to mid fours and short-term rates came down. That's really going to juice the economy. Banks are going to make money, financial companies are going to make money, and consumers are going to do well. Well, I don't want to say that this rising tide is going to lift every boat, because it's not. Things like staples and utilities won't be the place to be. They're more defensive. That's probably a trade for at some point in 2026. But, certainly small caps, I started pounding the table. I've got road rash, by the way, from trying this small cap trade so many times in the last decade or so. We've got a big position in small caps. I think pullbacks in small caps, people should buy. They're overweighted to the MAG, and the MAG stocks don't have to go down for small caps to work. That's still fine. I still like financials. A lot of things I like, just not as much as in April when the trade was much easier. Biotech looks good. Financials look good. I think into a little more weakness, I'll go back to a bigger position. In the home builders, they look good. A lot of the industrials still look good. Energy, which it's more volatile, but crude oil should be finding a low in here. And then that could be a story for Q4, some beaten down energy stocks. I think there's a lot of opportunity outside of those 10 stocks, which there's no problem owning them. But I think as they melt higher, people should take some chips off the table there and find some of the less sexy areas. And I won't say this, but at some point, look, the pharmaceutical stocks, the Pfizer's, Bristol's, Merck's are going to get a bid again. Again, that's a 2026